Welcome, dear friends. Today, we will explore another fascinating model of financial inclusion, the village banking model. This model has been a game changer for rural communities around the world, empowering them to take control of their financial futures. In this session, we will discover how village banks operate, the impact they have on local economies, and the way they foster trust and mutual support within the communities. So, let's dive into the village banking model and see how it's helping millions of people overcome poverty and build better futures. In many parts of the world, rural communities struggle to access basic financial services. Banks are distant and traditional lenders impose crushing interest rates, leaving the poor with little hope of economic growth. But there is one model of financial inclusion that has been making a difference: the village banking model. This innovative approach is helping communities take control of their financial futures by creating small, self-managed banks owned and operated by the community itself. The village banking model was pioneered in the 1980s by development economist John Hatch, founder of FINCA International. Hatch envisioned a model that would provide financial services to the unbanked poor without the need for external aid of middlemen. This model was built on two key principles: local ownership and mutual accountability. Hatch believed that local communities should manage their own financial institutions and take ownership of the entire process. Today, this model is used in communities across Latin America, Africa, and Asia, bringing financial independence to the world's most vulnerable populations. So, how does the village banking model work? It starts with a group of 25 to 50 community members coming together with the goal of improving their financial stability. With the help of a microfinance institution or an NGO, they receive training on how to manage the bank, distribute loans, and ensure proper governance. Members of the group elect their own leadership, such as a chairperson, a treasurer, and secretary. These leaders ensure that the bank operates effectively, helping the community manage its own financial needs. Each member contributes to a saving pool, creating the capital and the bank will use for its lending operations. Members can then take out small loans, usually ranging from $50 to $500, for the purpose of farming, crafts, and small businesses. Loans are issued to individuals, but it is the group that makes decisions about who receives the loans. The group collectively ensures that members are responsible for repayment. In the village banking model, no traditional collateral is required. Instead, the group guarantees each loan. If one member is unable to repay, the group steps in to ensure that the loan is repaid, fostering a sense of mutual responsibility. This system of peer monitoring and support creates a culture of trust where each member is committed not only to their own success but to the success of the entire group. Unlike many other microfinance models, village banks aim to become self-sufficient. The savings of the members form the primary capital, and any profits from loan interest are reinvested or shared among the members. At the end of each loan cycle, profits generated from interest payments can be distributed among members or reinvested into the bank for further lending. This structure encourages members to take ownership of the bank's success and long-term sustainability. The village banking model offers several powerful advantages. First and foremost, it empowers communities by promoting local ownership and decision making. Members gain financial literacy and leadership skills as they run their own financial institutions. Women, who are often excluded from traditional banking, are key beneficiaries of village banking. This model gives them access to capital, enabling them to invest in income-generating activities and improve the welfare of their families. By providing financial independence, the village banking model creates ripples of positive change throughout entire communities. Village banking fosters a sense of community, solidarity, and mutual support. Members rely on each other to repay loans and ensure the success of the bank. This social pressure reduces the risk of default and creates a strong bond of trust among the members. The sense of belonging and the shared responsibility strengthens the community's social capital. The model can be adopted to different contexts and needs. Whether it's rural farming communities or urban traders, village banks can be tailored to the specific economic and social conditions of the community. This flexibility allows village banking to thrive in various environments, making it a widely applicable solution for poverty alleviation. But like any financial system, the village banking model is not without challenges. In some regions, members may take out loans from multiple sources, leading to over-indebtedness. Without proper financial education and monitoring, this can result in financial strain and loan defaults. Additionally, the small loan sizes offered by village banks may not always meet the needs of growing businesses. As members become more successful, they may require larger loans that the village bank is unable to provide. Group dynamics can also present challenges. Disagreements over loan distribution, repayment schedules, or leadership can create tension within the group. Conflicts may arise over loan distribution, repayment schedules, or leadership roles, which can undermine the trust and solidarity of the group. Managing these conflicts requires a very strong leadership and communication skills within the group. Although village banks aim for self-sufficiency, many still rely on external NGOs or MFIs for training, technical support, and initial capital. This dependence can be the vulnerability if the supporting organization withdraws or is unable to provide long-term assistance. One of the most successful implementations of the village bank model has been in Latin America. Finca International has helped set up thousands of village banks in countries like Peru and Bolivia. Take Maria, a single mother in rural Peru. With a small loan from her village bank, she was able to purchase materials for craft business. Over time, she expanded her operations, repaid her loans, and took out larger loans to continue growing her business. Now Mariam plays a vital role in her community, not only running a successful business but also helping other women access the same opportunities through the village bank. The future of village banking is increasingly being shaped by technology. Mobile banking platforms allow members to access financial services even in the most remote areas. By integrating mobile banking and digital tools, village banks are becoming more and more efficient, transparent, and accessible, making it easier for communities to manage their finances. The village banking model has transformed millions of lives by promoting financial inclusions and economic empowerment. While challenges remain, its adaptability and community-driven approach make it a powerful tool for fighting poverty. As technology advances and more communities embrace its model, village banking is poised to play an even larger role in the global movement towards financial independence and poverty reduction. As we look ahead, village banking holds immense potential to continue transforming lives and fighting poverty across the globe. Thank you all for joining me, and I look forward to seeing you in our next session.